the markets, not the commentators. And what we've seen over the last few years is a lot of commentary on markets, and often it's by people who aren't all that experienced or people who are pushing an agenda. So you're not really sure what the facts are when people talk with economic commentary. So it's always best to go and actually look at the hard data.
Welcome everybody to another episode of Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down today with Barry Dawes. He is the executive chairman of Martin Place Securities. Thank you so much, Barry, for joining us today.
Pleasure, Justin.
Great. So we have a lot to dig into today, and I wanted to start with a saying that you have, which is that you prefer to heed the markets, not the commentators, or perhaps that's a bit of advice. So these days, as you heed the markets and not the commentators, what is your outlook on all things generally, the global economy, gold, miners in Australia, the gold price as well? And then also, I think a big topic that you've been keeping an eye on is a massive flow of capital from bond markets. So where should we begin?
Well, I think if we start with the basic thing, heed the markets, not the commentators. And what we've seen over the last few years is a lot of commentary on markets, and often it's by people who aren't all that experienced or people who are pushing an agenda. So you're not really sure what the facts are when people talk with economic commentary. So it's always best to go and actually look at the hard data. Now, whether it's in terms of what the marketplace is doing in terms of currency or the stock market or the interest rates or bond price or whatever, or whether it's going along and seeing what the tons of gold purchases by India or China. So if we look at those sorts of things rather than trying to cue off what the Fed or officials have said, we tend to get a far better outcome for our investment decisions.
And how are you applying that approach today?
Well, it means that you need to look at a lot of the granular data, the basic data, whether it's what's happening in the Chinese steel industry and crude steel production on a monthly basis, what's happening in terms of companies with their production data, exploration expenditures, and so on, drill results. So it's a matter of having that micro analysis of issues and then putting it in a macro setting. Now, the really big macro setting for us is to think about the flow of capital and where that capital is and where it's likely to go to. And people can talk about the equity market being high and overpriced and whatever, but that's only part of the story, because a lot of equity markets, in my view, are still very, very cheap. And they're not overpriced at all. But the elephant in the room is the bond market. It's had a 40-year bull market. And when you get long bull markets, you get complacency. And people don't understand the value. They might understand the price, but they don't really understand the value of what's out there. And when we think of bonds, we've got well over $100 trillion of bonds out there issued by governments and corporations. Many of these things are at very, very low coupons. Now, there haven't been too many bear markets or even mini bear markets in that 40-year bull market for gold, and consequently, there's not a lot of experience in bear markets amongst the bond market managers, in my view. And the other thing which is really important is that the coupons are so low. And the lower the coupon and the longer the duration of the bond, the more volatility in the price. And what we've seen over the last couple of weeks, and particularly this week, is a real breakdown in the bond market in the 30-year and the 10-year. And the impact of a 0.5%, 500 basis point increase in yield will have a massive impact on the price of those bonds. So we're looking at pretty severe capital losses. And when you're talking about $100 trillion of bonds under management with low coupons, the losses in the bond market is going to be considerable. So when we've got all the other issues of monetary expansion, fiscal expenditures, and so on, particularly as a result of all the COVID activities, there's a huge amount of liquidity in the system, and what we're seeing is inflationary pressures. Now, we've seen a lot of that come through in terms of foodstuffs, oil, and other energy, and energy particularly in Asia and Europe. The prices have risen enormously. So we're seeing inflationary pressures that will go through into CPI. We're seeing bigger numbers in PPI than CPI initially. But the oil price now is at a really critical level. On my numbers, if we get a break in Brent, the international oil price, through $83 a barrel, and we're just over 80 at the moment, that will break the downtrend from 2008. So that's quite a long-term downtrend. And what that break in the oil prices is really suggesting is that there's a recognition that there is not any spare capacity in terms of oil production anywhere in the world. We've got Saudi Arabia with a bit, we've got Iran as a wild card, but most of the other OPEC countries haven't even been able to match their the new quotas that have been given. So there are real production supply issues developing. And given that most of the growth in oil production over the past decade has really come from North America, from primarily the shale oil producers, we've seen that drop by about 3 million barrels a day, and I can't see that really picking up substantially over the next couple of years. And the world consumes about 100 million barrels a day, and so where's the oil going to come from? So we're looking at something which is really important in terms of the availability of oil and the impact of oil in the way economies work, and the impact of that on inflationary pressures. But the energy system is much, much bigger than that. It's all about hydrocarbons. And if you look around the world, most of the big economies outside of the OECD or outside of North America and Europe, they've got about 90% of their energy, their primary energy, comes from hydrocarbons. So when people are trying to stop new coal expansions, stop new gas production in various places around the world, it's going to have a really big impact. So India, Japan, or ASEAN, that's all the Malaysia, Indonesia, Thailand, Vietnam, etc. Those sorts of countries, South Korea as well, and Taiwan, those countries have got over 90% of their energy coming through hydrocarbons. So, and they're all importers of energy. So when the big exporters like Australia of energy, Australia's a big exporter of coal, big exporter of LNG, and a growing exporter of uranium, and the United States is a big exporter of energy. So when we think about those countries which have got domestic policies to restrict the production and export of hydrocarbons, and all these other countries around the world being major importers of hydrocarbons, the only thing that can happen is price of hydrocarbons is going to rise, and the inflationary pressures will be very great. So we've got a macro environment where the bond market is mispriced. It's looking at transitory inflation, and it'll all be wonderful, but it won't. And we've got a real supply issue for energy going forward. So when we come to gold's right in the middle of all that. We've got to look at the supply-demand position on gold and think about where that fits in with energy. So the biggest buyers of gold are India and China. So we see the numbers in recent times have increased quite substantially. And so when we think of the sort of 3,200 tons of gold that's produced every year, we've got about 350 tons of that in China, and about 330 tons out of Russia. It really means that the rest of the world is only there with about 2,500 tons, but most of that's being shipped to Asia anyways. So there's no availability of gold on a net basis to the West. And when we think about it, the West is underweight gold and effectively short. And we could talk about where COMEX fits in that and the short positions in the futures market. But at the end of the day, what we've got is a short position in the West that needs to be covered, whether it's to just increase portfolio weightings or buy back gold. We're really set up for quite an explosive move in gold over the next few years. Now, the next part of that to really think about is that the central banks have also been buying gold. We've seen really strong demand for physical gold, and we see premiums in the coin markets. And what applies for gold also applies to silver. But all these things are coming together to give us a really strong confluence of forces that'll push gold prices much, much higher. And we also have to think about the impact of rising energy on the cost of production of gold. So these things, as I say, they're coming together and they're combining. And so we will see gold move much, much higher. Now, in the short term, we've got, and by short term, I'm talking about the last 6 months, we've seen really obvious suppression of gold in the marketplace, where you could see COMEX would open and we will get a $20 or $30 slap down, and we saw it so many times. And this is price suppression. I keep on asking myself and other people, who's doing the selling? And people say, oh, it's the Fed or Treasury or whatever, but I don't think it quite works that way. So we've got to work out who sold 175 tons of gold in 60 minutes last month. Who's got deep enough pockets to do that? And you come up with a pretty small number of people or groups of people. And the only conclusion you can draw on is that the gold price is being suppressed essentially to protect the bond market. Because if you've got $100 trillion tied up in bonds, and if people start to think that inflation is coming through, the prices of bonds will fall, and the value of bonds under management will fall, and so the income to the bond fund managers will also decline. So I see interests associated with the bond market, the real people trying to suppress the gold price. But that can only go on for so long, and then we start getting short covering. So again, reinforcing all those points, it comes to the confluence forces that can mean short covering, tight supplies, and short cover rallies give very, very sharp moves in the markets. Now, when I look at the gold stocks and in North America, in Australia, I look at the South African gold producers, I look at the gold price, look at the gold price in all the different currencies. And what we are doing is setting up for a big move, and it's very, very close. Now, whether it's another month or whether it's tomorrow or 3 months, I don't know. But even though we might be pushed down in terms of price for stocks and gold, it's just deferring what will be, I think, quite a significant price explosion.
Great. That's a lot of information. So I want to kind of go back to the outflows from the bond markets and how unprecedented you see that as being.
I think it is without precedent. If we go back to the 1960s, when we had Lyndon Johnson's Great Society in the Vietnam War, and we had inflation that was coming through with that resulted in the OPEC or the formation of OPEC and the restriction of availability of oil, which gave a massive increase to the oil price. But that was at a time of increasing labour costs. Just everything was strong, inflationary. Now, in those days, if you looked at the US government debt or total government debt around the world, it was pretty small. And most of that debt was really managed by individuals in their stock account with Merrill Lynch or whoever it was at the time, and they might have had 60% in stocks and 40% in bonds, and that was a large portion of the bond stock availability, and the proportion of professional bond managers at that time relative to the total bond market was quite small. If you go back and look at the numbers of the total federal US debt at that time, I think it was about 400 billion. And when you start thinking of the total global bond market, there's not a lot to manage. So when we look at it now, there's 100 trillion out there. And we know that there's at least 70 trillion of that, which is actually managed by professional fund managers. So as the bond prices fall, you can expect people to withdraw their capital from bond funds and look to put it somewhere else. Now, what was interesting in the 60s and 70s and 80s is that to hedge the bond portfolios, the managers of the time would invest often up to 10% of their funds into inflation hedges like gold and gold stocks, resources companies, and so on. So that's where our hedge funds came from. So managers had funds that were there to hedge the bond portfolios. Now, that was quite small. So we come to today, we've got the $70 trillion under management, and those bond fund managers don't have any interest in gold because it's not part of their training or their experience, and gold has been regarded as that same old barbarous relic that Keynes said. So these people are unfamiliar with that. They're unfamiliar. They're underweight the energy sector. That's very, very clear. They're underweight resources. They're underweight commodities. So we only need a few percent of that 70 trillion to come in to hedge the bond portfolios, and that could be $2 or $3 trillion, which would make a huge impact on what is a very, very small market for gold and resource stocks.
Any other comments on that?
Look, the other thing that's really important is to just continue to watch the currencies and watch the gold price in various currencies. Now, you would be a little familiar with what happened with the Turkish lira last year and continuing. So the gold price in lira went up very, very strongly. When we look at the gold price in so many currencies around the world, and it's making new highs. It hasn't made new highs yet sorry, when I say new highs, relative to the highs that we saw in August 2020. But gold in many currencies has made new highs, but for the most part it hasn't. But when we start looking at gold prices in yen, if we look at it in euros, the gold price is stronger in those currencies than it is in US dollars, and that's one of the reasons why I'm still a US dollar bull and a gold bull. You don't have to be. You can see that gold prices have risen with a strong US dollar, I think the position in Europe, particularly as far as energy is concerned, and the European Central Bank, the way that's positioned, I think it's far worse than what you've got in the US. So to me, the euro is just a disaster, an ongoing disaster. So people in Europe are going to be buying gold as individuals because they'll see the gold prices making new highs. So as I say, the big macro picture that I paint is very powerful the way it's building, but it's not a negative view, because you've got to go back to that heed the markets, not the commentator stuff. Look at the granular issues. Now, housing starts in the US are at near record highs. Now, there's some funny dynamics there. Usually you need about 1.6 million units per annum in the US to match the population growth and demographic and geographic changes. But what we've seen in the since the GFC, when we had a bit of an oversupply, housing starts are well under that 1.6 million units, and consequently there's about 6 to 7 million units short. So we're going to see housing continue to drive the American economy in a way which people might not have expected otherwise. Now, obviously, with certain immigration policies in the US, you're still going to have to cope with that, and you've got the migration out of the disgraceful Democrat-run cities in New York and California and so on into these other states. So the building has to continue. And then when you see what's happening in India and China, these economies are still growing. We've got lots of commentators telling us how China is going to fall over, but they've been telling that to us for the last 20 years, and it hasn't. And China is 1,400 million people, and it's much wealthier. And even though the property is out of kilter, there's a lot more that's happening there. In India, with 1,400 million people, they're looking at 8% growth rate. So the world's not falling apart, even though all these other things are around, and the massive liquidity we've seen is almost guaranteed that the economy will continue to grow. And that's despite all the what I consider a massive overreaction to the COVID virus. So again, it becomes a pretty interesting environment, and this is why we have to come back and say again, why commodity stocks, gold stocks, silver stocks, copper, coal stocks, oil and gas stocks, why have they underperformed, and why are they so unloved when the macro environments and the components are so powerful? And you can only conclude that people just aren't watching because it's not their game. Their game might be the tech stocks, and there might be a big focus on electric vehicles and the lithium market and the way it might affect nickel and copper in the future. But the bigger picture is what's happening underneath that's driving all these economies. So that's a long introduction to why we should be looking at gold. Now, I actually view gold as the metal of prosperity, because the only time gold really rises is when India and China are buying. And so that's periods of prosperity. When we've seen false rallies in gold, and we saw that in 2011, and we also saw that the 2011 rally, which peaked in 2011, was after massive monetary stimulation after GFC. And then when we had the COVID issues in 2020, we saw a lot more money go into the system. We saw the gold price rise, peak in August of 2020, and it's been sort of on the decline ever since. And that's because it was driven by false factors, which is just fiat monetary expansion. So now we've got the real demand coming through, and it's just going to come up against the supply and the availability, and that will push that'll push gold prices and all commodities much higher.
So for the younger people watching something like this, and they're getting all this negative, I guess, data really about the direction in which really the whole world seems to be going. You mentioned that there are some positive sectors and spots. Could you maybe, on an end note here, kind of summarize why the 18 to 34-year-olds should be optimistic about the future and how they can protect themselves?
Well, I think they should be very optimistic about the future. We've got very dark forces at the moment, and there's so much concern about COVID, and there's great concern about climate change. And certainly when I look at all the numbers, the fear is totally misplaced. So if people can move away from the concerns about the end of the world coming because of climate change, which is just nonsense. It's just the empirical data just doesn't stack up. I'm a geologist. I've been watching sea level over hundreds of millions of years, and these things change. So young people, I think, need to come back, step back from high tech. High tech's wonderful. It's given us enormous productivity gains, enormous things in our lives, but you've got to come back to, you have to have food on the table, you have to have somewhere to live, and all these features, I think, are going to become a lot more important, and particularly when we think of things like housing starts, and I think we're still going to see quite strong development in motor vehicles, but there's a lot of investment in energy infrastructure needs to take place. So for young people, if they can just take the scales off their eyes and not be concerned about climate, recognize that that COVID really is an older person's disease, and as long as you're fit, healthy, it really won't have much impact on you. The recovery rates on these things are really high. So they should be looking forward to the future. And if they think of gold and silver as metals of prosperity that will grow with them in their lives, I think that they can make some pretty interesting and very rewarding investments that have a soundness to them, and not necessarily but potentially quite short lifespans that we might see in some technologies.
We've had the honor and privilege of sitting down today with Barry Dawes. He is the executive chairman of Martin Place Securities. You can find Martin Place Securities at mpsecurities.com.au. Thank you so much, Barry, for joining us today.
Thanks, Justin. Thanks for the opportunity.
Pleasure's all mine. And thank you, everybody, for watching another episode of Inside the Markets presented by StockPulse.com.